Hi everyone, here we are again, me and Andrew Fox. Today we have An-Lap Vo-Dignard. I hope I spell it correctly. You know, I'm not very good with my accent, An-Lap.
No, it's
But
fine.
again, it's
Wonderful to be here. Tiago, you're a legend in the industry, so very happy to be part of your podcast and happy to meet you as well.
Nice to meet you.
that won't save you. That won't save you from difficult questions, An-Lap. Just for the people who don't know An-Lap, An-Lap is more than 20 years of experience in wealth and portfolio manage industry. It is based in Montreal, Canada. And again, An-Lap has done everything. He's a big advisor, especially with structured products. He used them a lot in different ways, different vehicles, from notes, from using in funds. So it's really excited to have you on An-Lap here. So thank you for accepting to actually give some of your knowledge.
Thank you, and I have to say it's a team effort. We're a team of 23 people, so I only do coffee within the team. That's mainly my role.
Look,
No, it was something Tiago, we're passionate about structured
uh-huh.
products, and we do have long-term expertise in it. We started way back then. I'm happy to be at Bank Financial, where it's open architecture in terms of platforms. So we do use product from National Bank, but also from RBC, CIBC, Scotia, TD, all the banks, BMO,
Yeah,
as you know, and even Desjardins. So we could
yeah.
have open bids for to the benefit of our clients and to the benefit of every suppliers out there because they have all their different strengths. So we have a personal relationship with each of them, and we appreciate their help in bringing the best products forward for our clients.
So I'm going actually to start on that, right? Because with this more than 20 years of experience, what has been the differences in the development of structured products usage within Canada Wealth Management?
Yeah. Uh, So Tiago, we've known each other for years, so I've been on different panels. And then, as you know, I was a very vocal advocate to tell suppliers and tell the ecosystem that it's true that some advisors don't understand the products, and education is a big portion for the advisors and for the clients as well, for the clients, but also for the advisors. I do help some colleagues sometimes when they have questions about structured products or refer them to some suppliers. But also, we've been developing a lot of internal tools for portfolio management because otherwise, every structured product is like an IPO. So they're great, and education is a good portion of it. We need, scale is becoming more and more important. I was mentioning I started alone, and we're now 23 people within the team. We're in excess of 5 billion under management. It's not like when I started. So you need to have tools to manage scale and risk management and know how much you have into which underlying, which sector, what are the maturity dates, and to diversify it properly and have a proper portfolio management and not just see it as a single product. So we've been a lot of pilot projects with some suppliers. I was on a panel in the US because we're dual license with the
Hmm.
founder of ALO. And I know, again,
Yeah,
not to try to avoid tough questions, but I know, Tiago, you're kind of know, uh, like a library. We're compiling all these data. So I'm gonna pick more your brains later to try to help us develop more tools for portfolio management. So
so
so we've been developing a lot of internal tools
uh,
that we share. Some we don't share because we got to keep some portion, to keep
I
an edge. But I think that's becoming more and more in the industry, and that's gonna help the industry going forward.
So for the people, right, especially for the advice and that do not use structured products, as well as for structured products practitioners who don't know wealth management, what for you is the value of structured products to your clients, to your wealth clients?
Yeah, so structured product are like there's a lot of misconception about structured products. So first of all, we're wealth management division. So I don't want to have a discussion for branch structured products, which might be some differences. The more GIC linked returns. So we have access to structured products we use the most are the ones with what I call partial capital protection. So you can have some 100% capital protection, but if you have a longer term, 7 years, and you have a minus 30 on a well diversified underlying, we can always even debate if that 30% is necessary, but it's good to manage clients' emotion and keep them disciplined in the investment process. So what we're aiming is our asymmetrical returns. You want to participate on the upside, but limit on the downside. And also, so what we found with our expertise, because there's knowledge behind it too, like stocks, there are good stocks and bad stocks. So you need to have a process and have a filter. We do have a very rigorous filter process at the VP Group to choose those structured products, but we're getting equity-like returns with much less risk than equity. So if you have a very wealthy client and he doesn't want to be 100% stocks because he still owns a private company and it's a lot of his overall wealth. And then what's the alternative? You want to be in bonds with rates that are very low, fully taxable. So this is a great in between. And there's some cycles where you could actually beat the equities with much less risk. So it's risk adjusted returns that we're looking at and asymmetrical returns. And we've been performing very well with that.
Canadian investors, do you see more kind of hunger for the partial protection you're talking about, or do you see more of the kind of vanilla autocallables and more basic products?
It's a good question. I find it depends on the advisors. So if the advisors don't understand the product, they'll stick to vanilla. Also, it helps if you have some repeat notes and you keep the same structure and the same underlying, because otherwise we have several advisors within the team. So associate advisors, 3 years down the road, if you need to go back and look at the prospectus again to be able to explain it to the client, it's going to be difficult. So we do like to have some repeat stories where we're just looking more at the coupon and a simple structure.
Now, the other thing, right? And we discuss it, right? So many times, structured products are simple in my head, and I know on yours too. But of course, there can be, more complex structured products, right? We've seen like the decrement indices being used in Canada. I mean, we have like the point BC decrement indices that have been used and it's been suffering, right, the last 9 months. So, what's your approach to make sure that your client understands what they're investing in?
Yeah, so that's a very good question. And I think um, you know, on this panel we all we understand structured products, but for clients, it's our job. If the client doesn't understand, I always stay within the team. It's not the client's fault, it's our fault. We need to explain properly and make him understand, and then it's not going to be a black box for the client. So the way I do it, and I had a new advisor and I was surprised. I was discussing with a client, and it's a new client, and we're talking about structured products. And the client was excited. It was auto-callable that was, I don't know, 14% per year linked to Canadian banks. So he was ready to sign. So I felt that. So I was bringing a lot of negative information about structured products. Be ready, Canadian market will not be the first day you're going to see on a statement, you're going to see it down because it's almost like breaking a contract. So I was trying to explain to him, and I was really, it's like a vaccine, right? That you agree or not for the
Yeah.
vaccine. I don't want to get into that, but it was telling the clients in advance, be ready for that. And then I was giving him more and more, I would say, negative features or perception about structured products. It's not liquid. We're probably going to get called. I remember your stats, Tiago, like autocallables on average get called 3.5 years. I think you run,
Yeah,
but we
yeah, yeah.
time, the entry points. We're not doing market timing, but we tried to find a good window for the underlying, and we actually went back, and our historical average is 1.5 years only for autocallable because we do time and we just don't roll them over without thinking, is it a good entry point for that underlying? So it's very, very short holding because we do get called on it. Sometimes we always wonder if we're too good and it would be better to stay in the structure and get paid 14% at the end of 4 years or 3.5 years, like you mentioned, than being
Yeah,
called quickly. The clients are
yeah.
happy, but in terms of portfolio management, sometimes it's better to have a longer holding period if you have a high coupon. But after the meeting, the new advisor asked me, why were you telling all this negative? Like the client was already, he wanted to invest and you
Right.
were telling all this negative. I told him it's my job to manage and lower the expectations at the
Yeah.
minimum. I knew he was going to say yes. So I'm going to manage the expectation at the minimum, tell him everything that's negative, and then he's going to be super happy because he knows already about all
Yeah.
these things. I said, remember, I told you secondary market was not good. You don't need it's money you don't need. Worst case scenario, you have to wait 7 years, and that's going to be the real home run if it goes bad for 6 years and
Yeah.
7 years, and then you're going to be super happy. So all the negative, I told him in advance. I'm guaranteed he's going to have a good experience with me. He's going to be super happy and send me new clients. I think a lot of advisors are doing the mistakes on going just on the positive structured products and
Yeah.
not mentioning both sides, and I think there's no problem with the not the flaws, but the if you tell in advance and it's not a surprise, people don't like to be surprised, and then
And
you talking to
yeah.
them when they're not happy, they will not listen to you. If you tell them at the beginning, I don't have any problems with our clients.
And ultimately, right, you will never get complaints when the product goes well, right? The complaints always when the product underperforms.
Exactly. So if I can lower the expectations, whatever we'll do it, they're gonna be even more happy. So that's the way I did it. So the advisor after that understood, and he's running away with it. He's very good now to also lower the expectation that well and be transparent about how a structured product works.
Do you feel like it's gotten easier? Obviously, you've had a long career. Do you feel like over the last 20 years, education has improved so people understand it more? Or is it still the same as it always has been?
It's a good question, Drew. I feel it's easy for me because when you've been doing something
Hmm,
20 years
of course.
and the advisors within the team, and we develop some internal tools. I do see more advisors. I see the numbers, and Tiago, you see the numbers, and it's probably thanks to people like you, both Drew and Tiago, where you're promoting awareness about these products and these amazing tools, great tools about structured products. So there's more advisors, and we see the market shares. The inflows for structured products are increasing, especially in the US, where I think Europe was and Asia were in advance in that regard. But there's still a lot of we need to educate the public. I ask the banks, and there's legal things about it where they say they can't advertise it as much as they would want to, maybe, or they're
Yeah.
scared to. So that's a big hurdle. But you know what? For us, the way we see it is when there's it's a barrier entry, entry barrier, and we see it as an opportunity for us to be ahead of others in that game. So if it was like very public, yes, there would be more, but then it would be easy, and sometimes there's no arbitrage opportunity when there's a little bit more friction. It's more complicated. It is a lot of time. So I see some colleagues that understand structured products, but they say, I don't want to explain that to the clients and re-explain after 6 months because, as you mentioned, Drew, there's not enough education tools geared towards the public, or the ones that they're out there are too simplistic, maybe, and maybe because the banks are scared. I'm not saying anything
Yeah.
about the banks. I don't know what it implies in terms of compliance. I'm not saying like they
Yeah.
should do it. I don't know the implications. But the minute you have a little bit more sophisticated client that asks question, he thinks like these products are not for me. They're for only people that are scared about the markets. I'm paying for nothing. There's a lot of bad structured products out there, and it's
Hmm.
important to cannot just blindly buy any structured products. You need to understand them a little bit and do your homework, due diligence, like you would for any other investment vehicle.
Yeah, definitely.
But thank
So
you guys for promoting education in that space because it's still needed, Drew. It's unfortunately or fortunately for people that can use that to our advantage and for to
uh
the benefit of our clients.
you look, I think An-Lap, you're one of the companies that actually is pure open architecture. We work with all the banks, right? Which is always positive for the client, right? Because usually they get the better price. So how do you work with the issuers and the product providers to ensure that, especially on the node sides, that aligns with the client's objectives?
Yeah. So So it's bad because I have too good of a relationship with Tiago. So I'm giving too many information about our secret sauce or secret recipe for success. It's very important for us to spend that time and get competitive bids because each bank will have cycle. So it's like you have a business and you say, okay, I want to start real estate, and then the bank has too much in the portfolio and they don't want anymore, even though you're a good
Yeah,
project. So you have
yeah,
different cycles within different banks where they're more aggressive for one type of structure or one type of underlying because they need to hedge themselves about specific risks. So at any given point in time, you will get huge differences between the pricing from one bank to the other. And even if you negotiate, so I've seen, and I'm not going to mention any names, but we have advisors that are coming from other institution, and I know the traders for structured products. I know them well. I'm happy. I'm like, wow, that's good. You're good added value for the team. So I'm like, so you negotiate with them, and who do you know at other institutions? And the person is like, we don't get bids from other institutions. But I
yeah,
guarantee you, Drew and Thiago, if you cannot get bids from other people, you might squeeze them a little bit, but that's it, right? They know you're captive and you have to buy from them. Or you
hmm
could buy something else, but if you want a structured product, you need to buy from them. So you're gonna move the needle a little bit, but we've seen differences by as much as 4% yearly on untouchable from the best bid and the worst bid. So
wow,
yeah, it's huge. It's huge. So for us, it's worth the time.
hmm
It's an art too, because if you get the best bid, but your entry point you miss it, especially with the president in the US where the markets are very volatile, you get
yeah,
4% more, but the underlying bounce back and it's now too expensive. It might be not to the benefit of your client. So time is of the essence. So you need to get competitive bids, but also if we have network of suppliers, if we have one, and it did
yeah,
happen where he was coming back. It was taking too much time, even though he would come back with the best bid. But like it's too late. Like you're slowing us
yeah,
down too much. So there's a balance between getting the best bid, but timing.
and the
We do
timing.
have a good reputation. We do have scale, and we use that to our advantage. But there's some tricks I can give you. But we do establish personal relationship with the suppliers, and when you have a
Yeah,
reputation, you can send them. It's guaranteed. It's like like a bad deal. I'm not gonna back out on
yeah,
my word because the underlying moved. We'll send them the 10 million, 20 million. When
yeah.
we have a commitment verbal, it's done. So we do have that reputation and we'll keep that reputation no matter what because it's to the benefit of our
Which is
clients afterward.
important. Yeah, yeah, exactly. It's always about the long term. The other thing which I want to ask, you mentioned, right, because of Trump and what happened with the tariffs, right? And let's not talk about not today about Canada and the U.S. relationship. I don't think it's worth it. But one of the things I've saw recently is when the tariffs have happened, a lot of the US banks they went to the market, they got a lot of funding, and what we've seen after that, because they are rich of cash, their funding has decreased, so they don't need as much. So the US banks are being much less competitive now, for example, in the US, but also in Europe, and other manufacturers, European ones, Canadian ones, are now getting more market share. So how do you compare the Canadian market with other markets? What do you think it's like the big difference of the Canadian market, and what do you learn from others?
That's a good question. We're one of the few where we're dual license. So I'm licensed in the US as well. So we have
Hmm.
US clients. We're allowed to have US clients. So the platform is and the products are very different. Very, very, very different. Taxation is different. I would tell other advisors, Canadian advisors, if they want to go for that market in the US, it's a great market, but they have to be careful and depending which states, it's more problematic than they might seem. So I actually think we have an edge in Canada. I like the Canadian products more. I have access to both, but I like the Canadian products much more. So if you see the industry, again, there's pros and cons, but people would complain that in Canada there's only six banks. It's not a monopoly, but you're not happy about the price of the oil at the pump. You go across the street, it's the same price, right? Kind of the same with Canadian markets. I don't want to get into debate and people saying they make too much money, but if you see in 2008 we didn't have the same problem Mark Carney like had a very good reputation after the
Yeah.
crisis, financial crisis, 2008, Bank of London and England, things like that. But the market is very different in Canada in terms of being much more secure. They might make too much money, but then they're very solid. So that's the pros. So if you have an issuer that's Canadian bank and you've seen like would be Silicon Valley Bank in the US, or it's much more fragmented in the US. So in terms of telling the client, well, you have stocks or you have bonds or you have this great in between, you don't want the client to say, I'm paying for a protection, but then I'm wondering, even if it ends up paying, you don't want the client to wonder how strong is that protection really is. So you have that advantage in Canada when you talk to a client and you say it's guaranteed by TD, or it's guaranteed by National Bank, guaranteed by BMO. The client like will sleep well, and it's not even wondering if there's a possibility that there will be a default. So we stick
Yeah.
to um, which are the one banks in Canada, and then it's on the books of the banks, and then the client is much more comfortable with that. We see longer terms
Hmm.
in Canada as well in terms for the product. So I really explain to the client, if you have an auto callable and it's a 3-year term versus a 7-year term, it's an advantage to have these additional years because you have an advantage to either come back in the protection buffer or to get paid to make a profit. So these additional years are not detrimental because if it's
Hmm.
positive, you get called anyways and you don't go towards the end. And for us three, that's like obvious, but for the client, it's like, but I want to be locked in for 7 years. I'm like, you understand it's wrong. So having I see a lot in the US 3-year terms. To me, that's not necessarily the best time horizon for, let's say, autocallable structured products. So I like the inventor in Canada. I like having 6 banks that can get competitive bids with peace of mind in terms of the protection as well. So I do like the Kenyan market a lot in terms of the offering and what we can bring forward for our clients. And there's good products as well in the US, but we actually are in discussions a lot with Canadian banks, like your friends Jerome at BMO, that covers their position in the US, or TD or others. All the banks, Canadian banks, have a presence in the US to say, can
Yeah.
you structure a product for US clients? And Canadian banks worldwide have a very good, the banking system has a good reputation, and
Yeah.
and so that's to their benefit as well.
Do you feel like the kind of like six bank quasi monopoly you have over in Canada, do you think that kind of helps or stifles innovation in the space?
If it helps.
Yeah, does it help? Does it stop it? Does it hold us back at all? Which way do you kind of feel on that?
The National Bank, okay, I'm gonna be an ambassador, but I believe it. I started my career at another Canadian bank, and National Bank is big enough. So it's chartered one bank. So you have the same like risk systemic ones. So they have in terms of you need the ratios are to be higher and terms like that because the governments all learn after 2008. Well, in the States, they're removing some of these. I don't want to get into that
Yeah.
discussion. So it could be good short term, but long term, to protect the public. Anyway, it's another discussion. But in Canada, it's very regulated. And I think it's important to protect the public and to protect that is if a large bank goes belly up, everybody's going to need to chip in. So you say it's going to be the problem of the government because they call it too big to fail. So in Canada, it's if you're like risk a charter one bank, they come in with more compliance, with more like higher ratios and things like that. So that's I think again talking about the strength of the banks and the strength of the security for the client, protection, where they don't have to wonder if it's gonna be a Lehman Brothers or so you have that positive in Canada. Then are the fees too high? Maybe, if you have less competition. In the US, you'll have one bank that's gonna be doing only credit cards or only credit cards for tech people. So for sure it's more competitive, but then you have a bank like Silicon Valley Bank, which is only for tech people and that's large deposit. And when you have a few companies that withdraw at the same time because they're credit crunch in one sector, and then there's a problem because if you have more diversification and you have tons of retail clients, so that those retail clients for the Canadian banks, that's mass market. That's the strength of the Canadian banks. So there's for sure there's a lot of flaws, like the fees are probably higher, and things like that, and you're much more captive. For at National Bank, I see at other banks, and I'm not going to mention names where you don't have that open architecture, then I'm not sure that's for structured product, that's to the benefit of the client. Because like I mentioned, between the best and the worst, 4% difference. So we do very well justify our fees, and we show that to clients. We keep track of the bids, and it's a true process. Like we do send an open bid, and we don't care. We're paid a fee, so we don't use structured products that are commission based. That's a choice, but we're only fee based. So if the client has a better rate, the assets under management, you're both on the same side of the equation. I'm gonna make more money too. So it's our in DNA to squeeze the best bid for the client. So we have the strength of Canadian bank, but we have
Uh-huh.
that independence. It's not always the case with all the banks, but I know the industry, Drew, but I can't mention it. But off the record, I can tell you which one are the worst, but not on a podcast.
So let's talk about something else, right? Because as a wealth
But I do believe
manager,
National Bank is the best for letting us that entrepreneurial spirit. I did change banks. Well, I believe that the day they will not let us be independent, they're gonna get pushed back because they attracted a lot of advisors with best of both worlds
that's the
and open
market.
architecture,
Yeah,
and letting us that freedom to the benefit of our clients and to the benefit of the
oh,
bank,
definitely.
because I can attract more clients, and
More
they.
clients.
Exactly. But that's the
It's a very
model
good
at
point.
National Bank. I can talk about all the Canadian banks, and I want to get into that discussion.
And on as a wealth manager, right? Structured products only one of the tools and asset classes that you provide to your clients. So how do you use structured products into a portfolio context?
That's a very, very good question, Tiago. That's one of I think, one of the big advantages we have, where we have, and we also have our own private fund. So we're both IROC and AMF, and that's very rare. So we have, all the banks have funds, but we have a fund which is a balanced fund, and we're a Morningstar. We have a track record. We're doing very well also, but it's either tactical asset allocation or balanced fund. You can decide how you call it, but and we have a long-term track record. So we do manage different asset classes, and I do believe that as much as I love structured products, and I know you guys are doing purely structured products, and there's some advisors out there that are doing purely structured products. I would say that's not the most, there's less advisors that are doing purely structured products than different asset classes. There's cycles too, and you need to understand the markets, and you need to incorporate your forecast. Do you want more? You think it's going to be a cycle for rock, return on capital, or you think you're very bullish on the market and you want to, a growth note or accelerator or booster note, or there's different structures, and I think there's timing to that too. There's an art form to that, and you need to understand all asset classes. Otherwise, if you're purely in structured products, and you're gonna get great returns, but I think you're gonna maybe, there's some additional incremental returns or lower risk that you can get by understanding other asset classes and managing that other classes. There's no other way but managing these other classes to really know in depth, how it affects the structured product. So we do manage, all the asset classes, and have a diversified approach, and structured product is one of the tools, but we do look at correlation with other asset classes and timing wise, Tiago. So that's a very good question.
So let's talk about future because you've been in this industry for far too long as me. We're getting old. And what do you think is the next generation of structured products in Canada?
Hmm. I think I see it changing. Yes, there's gonna be. I think the in Canada will benefit a little bit by um more offering in terms of different underlying. I see a lot of structured products linked to Canadian banks. It's Canadian banks or Canadian, and there's others out there, but let's say autocallable, or the bid you're gonna get. So I think and that was maybe a little question about Drew. So I think they need to not become complacent, and they need to develop that expertise to get good bids. They offer bids, but I want a good bid on or good pricing for other underlyings than just Canadian banks. So otherwise it's a little bit lazy. So not that they're lazy, but if it sells, you just repeat, that vanilla
You repeat
product.
the same.
But they
Yeah.
should also have in terms of diversification. Otherwise, it's not well diversified in terms of portfolio management. But also, I really believe they understood that message. I don't think it's just me. I think, but to develop portfolio management tools, and I think that's going to be the biggest game changer for them. I always try to put myself in their shoes. I'm like, guys, you're going to get more, like market share with investment advisors. The game is changing, becoming institutional portfolio manager with the assets we have, discretionary portfolio manager. We press on a button, we can send you large, amounts, but you need
Transactions.
to give us those tools to have real portfolio management, and the industry needs to speak to each other to have common ground, and they present the data differently from one issuer to other. That in mutual fund industry, that so to speak, just like beta and VHS. I'm old, so VHF, SS, and beta, like one needs to die. Like, and just pick one format and then stick to it for all the issuers, and then we can
Yeah.
download the data and have some tools to have portfolio management. So I think they're going to increase their share of wallet in terms of
Mhm.
different asset class. If I think that message, they're understanding that.
It's
Do you
and
feel like it'll
that's
be?
a very. Oh
Sorry, go
no,
ahead,
go.
Tiago.
Sorry.
You sure? It's up to you. I can go.
Yeah,
I'll go.
go
Yeah,
ahead.
it's fine. Do you feel like it will be kind of a domino effect where you'll see one pick it up quite early on, and then as they're getting better and better, others will kind of go through and push through with that? And
I
what do you think
would
is preventing that first domino?
I think if one Canadian bank has these tools, the other are gonna get scared, and we're kind of doing that. We're saying, oh, there's one bank that signed an exclusive agreement with Halo. The ones are want to develop internal tools, and like,
Mm.
well, if or that bank helps us, develop internal tools, we're gonna take that into account. They're both equal price. So if they're putting efforts, we're gonna reward them because it's again it helps us do better perform management for our clients. So it helps our clients. It helps me. We're gonna it's a partner. It's like a partnership. We don't see them as purely suppliers. We develop, and when you establish a partnership, and then they'll go above and beyond and try to help us win that trade. If let's say we have a big potential client, they're gonna help us in presentation. It'll go above just giving me a price and just a bid. I don't want a transactional relationship. I want like a real partnership. So I'm respectful, and it's a win-win in life, and then they'll help us more, and everybody wins, right? So that's
Yeah.
my approach, and but I think if one bank has these tools, all the others are gonna run to offer it, because otherwise that's gonna be a big advantage compared to the others.
So, what advice would you give to advisors just starting incorporating structured products into their practices?
To come see me, and I might hire them, but it needs to be there needs to be a commitment. They need to fully understand that. It's kind of like technology. Somebody once told me, like, if you don't understand, don't do it, because it goes very fast, right? It's like you know somebody that doesn't go LinkedIn and you post, and like everybody sees, like, with technology, pros and cons, like you were discussing. There's big advantages, but there's big disadvantages when you go very fast. You can run
Yeah.
into a wall very fast. So they need to understand the products and take the time to fully understand. Have my options license, so that helps. You need to not just take something off the shelf, what we call off the shelf. We did some offering, but some suppliers, I think they're all. It's important to go sit down with them. They're all very generous with their time. They'll gladly educate the advisors. Maybe something that you, Tiago, I think they're gonna be. They should thank you for that. I'm gonna recommend that they should integrate it in the rookie class. I don't think there's a portion where they educate the advisors in terms of structured products in the rookie classes. So that could be incorporated for all the banks, and that's going to be to the benefit of all insurers. So you should ask them a 10% cut on that one.
You're
They
giving me
could do that,
ideas. You're giving me ideas, An-Lap.
but they should go sit down and they should go sit down with several um, uh, suppliers or team by different banks, because they all have their strengths, and sometimes one could be really good for the product but not necessarily a good teacher. That those are different things. They could, even if they don't have much access, I recommend they try to go uh, ask to sit with several of them, and then they do change within the industry. They can change, so they'll be happy to meet them, because that's a potential new client, and they could change bank at one point in their career. I think they'll gladly sit with them. So a little bit of education, and then learn how to present it to the client. You said, I think one of you guys asked me at the beginning, is easy to explain? Easy, yes and no. We developed ways to explain it. So they need to have that little test run at the beginning, and not be, the advisor don't understand, let's say secondary, but sometimes you have experience too. So like secondary market, you only learn that with different cycles once it happens, right? So at
Yeah,
least
yeah,
we
that's
have an
true.
advantage being older, Tiago. You know, when we won that Hall of Fame award, we won
Yes.
Best Advisor, but Hall of Fame, the young guys at the office, you said, in the hockey, when you win Hall of Fame, it means
Yeah.
you're
You're,
retired. So they were making fun of Jan and I, saying, you guys are definitely getting older.
that's very true. Actually, let me ask you a personal question, right? As you know, there's up and downs in life, right? Especially professional and as well as personal, right? And you've been in this for more than 20 years. How do you keep motivated?
Well, I was lucky that I'm passionate about this, and we do manage all the asset classes. I'm really passionate, as you know, about structured products. I think it's sometimes people say, oh, it's a complicated product, it's long to explain, but I do believe there's a lot of value that we can bring to the clients for that. And once I see the clients, and large clients, once they understand them, they love them. They understand that they could get, have great returns, but have a good protection, very good protection level with these products. I'm passionate about that. I like to educate too. My mom was a teacher, so I think you need to have that patience. You mentioned new advisors. You need to have patience with structured products. No, and with the team, I'm very. I'm a stage where I'm really happy, Tiago, because when you start and you hire people, let's say you're a team of 5 people, you need to hire people that, it's like football, or that you guys are watching. You need to be good to score goals, but also play defense, and you need to be generalist, because you're only 5, right? So good to talk to clients, good to do perform management. Now, the more the team is growing, I can hire specialists. So some of my analysts, they'll meet a client and they'll say hello, and they look down and they walk away. But they're amazing, and they're really smart, and they're amazing at what they do, and I cannot do what they do. So now I'm bringing. I was making a joke, but yes, it's part of my job to attract talent and people that for this are going to be much better than me. I'll have the 360 overview. You cannot buy experience, so that's the advantage of being old, at least. That I've seen different cycle. I've spoken to
Yeah,
clients, and psychology too, to keep the clients on track, and see the 360 overall, where sometimes they're really good at something, but they don't see the domino effect. So I do look at the entire ecosystem. But now I get, and it's easier. It feels weird, but it's easier to hire a specialist than somebody that's okay, kind of be good at everything, jack of all trade, master of none. So now
yeah.
they're really, not to say in the past they were not good, but they were more generalists, and I had the budget that I had to. So now I really structured like a company where we have 4 analysts purely dedicated, with Jan and I as portfolio manager, but purely dedicated for portfolio management. They don't see the client. We have some amazing financial planners for estate planning, and they have a master's in tax. I'm a
Yeah.
generalist for that. I understand plan giving, and but I'm not a specialist. So we'll have that within the team. So it's really structured
Uh-huh.
like a company. So my entrepreneur side is happy for that. So I still have passion. At one point they'll kick me out, but I'm still there for until they kick me out.
Great. Look, thank you, An-Lap, for your time. I think you covered a lot. You gave us a lot of knowledge. To be honest, I think I'm going to listen these multiple times. You sent some bitey comments about me and some of the things, so I definitely want to listen and make sure I don't forget about them. But yeah, again, thank you, An-Lap. I hope you liked to be here with me and Andrew.
Well, thank you to you both, and I do believe it, and I know you're are very passionate about this, and I'm sure if Drew is on board, the same, and you're moving the needle, because I think these products are to the benefit of a client and to manage risk compared to some other investment vehicles. And I know you're doing a lot to educate the market, to bring different banks together and talk to each other. And I think that's the most important for the industry and for the clients. So yes, there's only 6 banks, and I'm amazed that there's not more synergy, and it's thanks to players like you in the industry that are outside of the banks and bringing people together, that you're making the industry go forward. So I'm very happy to have been part of your podcast, and I hope I
Thank you.
wasn't too boring.
Not at
No,
all, not
it
at
was very
all.
interesting.
We will have you back on whenever you want to. Do not worry. 100%.
Exactly. Maybe
Thank
maybe
you.
in Montreal. Thank you, An-Lap.
Of course.
Great. Perfect. See, Andrew, we need to book our flight.
Oh, the dream. I'm on Skyscanner already. I'm working it out. Don't worry.
Thank you,
Take
guys.
care. Bye.
Wonderful. Thank you
Bye.
so much.
Okay.